The higher your net worth climbs, the easier it becomes to die politely. That is the truth. Nobody likes to say. Poor people think money problems live at the bottom of the mountain. They think the danger is simple. Not enough income, not enough savings, too much debt, too much month left at the end of the paycheck, and those dangers are real. I have never romanticized being broke, but I will tell you something harsher. A lot of people survive the bottom of the mountain only to lose themselves higher up, where the cliffs are prettier, the air is thinner, the gear is more expensive, and the mistakes look respectable. That is where grown men with large portfolios become fragile. That is where high earners become servants to their own burn rate. That is where intelligent people start calling laziness prudence. That is where paper wealth begins to look strong, while the life underneath it gets weaker. I have watched this happen for decades. A man gets richer and thinks he is getting safer. A family's assets rise and they assume the danger is behind them. An investor has a few great years and starts confusing altitude with invincibility. That is when the mountain begins charging. I want you to understand the mountain properly. When you are poor, the danger is obvious. When you are climbing, the danger changes shape. And when you have real money, the danger is often no longer the lack of opportunity. It is the new set of traps your rising net worth creates. I call this altitude risk. Altitude risk is simple. The higher you climb, the less margin there is for stupidity that looks sophisticated. At sea level, a bad decision hurts. At altitude, the same kind of decision can take away years. At sea level, chaos is obvious. At altitude, chaos often arrives dressed like success. That is why I do not judge wealth only by the size of the account. I judge it by how cleanly a person can keep climbing without stepping into the traps that appear only after the first money starts arriving. The source material you gave me is fundamentally right about the shape of the problem. It is not one trap. It is a whole ridgeline of them. Over-concentration, lifestyle inflation, tax inefficiency, lazy refinancing, overworking, arrogance from early wins, financial complexity, too little liquidity, retirement delay, weak insurance. Most people treat these as isolated mistakes. I do not. I see them as altitude failures in one continuous ascent. Fay turn 68, file 0 Fay. Let me show you what I mean. The first trap at altitude is what I call the single peak illusion. A lot of investors get rich enough to feel confident and then stupid enough to bet too much on one thing. One stock, one company, one founder, one sector, one story. One narrative they have fallen in love with so deeply that they stop seeing it as a position and start seeing it as identity. That is not investing. That is worship, and worship is expensive. The source material uses the clean version of the rule. More than 10% of your total assets in one position is concentration risk. And most disciplined professionals do not want one stock above 5 to 10% of the portfolio. That guideline exists for one reason. Mountains do not care how beautiful the view was from one ledge. If the ledge breaks, the rest of the climb does not matter. Fay turn 68, file 0 Fay people always tell me the same story. This one is different. This company is too important. This founder cannot fail. This trend will define the next decade. I have heard versions of that sentence in every cycle. Railroads.com, housing, crypto, AI. It is always the same emotional structure. Intelligence slowly becomes emotional dependence. Then a person stops managing risk and starts defending a belief. That is how portfolios become shrines. The Intel example in your source is a perfect reminder of how long one peak can remain a graveyard. At the top of the dot-com bubble, Intel reached heights that even the current excitement has still struggled to reclaim. While the broader market compounded far beyond it over the same long window, that is the insult concentration delivers. You do not just risk losing money. You risk losing time inside the wrong story while the wider machine keeps moving without you. Fay turn 68, file 0 Fay. This is why I say the first rule of altitude is not admiration. It is spread. You can love a business and still refuse to let it own your future. You can believe in a company and still refuse to build your whole life on one outcome. Worker versus owner, belief versus dependence, conviction versus worship. You need to know the difference. The second trap is heavier, softer, and in some ways much more humiliating lifestyle inflation. I call it the velvet backpack. When people earn more, they almost never think they are making themselves fragile. They think they are rewarding themselves better house, better car, better school district, better vacations, better subscriptions, better furniture, better convenience, better routines, better excuses. Everything becomes better, except their freedom. That is what the source material gets exactly right with the Goldman Sachs paycheck to paycheck numbers. People expect fragility in lower incomes. They do not expect to find it among people earning $300,000, $500,000, and still somehow telling the world they live paycheck to paycheck. But high income does not kill fragility if spending climbs with it. It can actually decorate fragility and make it harder to detect. Fay Filicite Fay turn 68 file 0 Fay a heavy velvet backpack still breaks your back. It just feels luxurious while it does it. This is one of the great errors of modern success. People think the point of earning more is to raise the floor of their lifestyle. I think the point is to raise the floor of their freedom. Those are not the same thing. The family with higher income and lower retained leverage is not stronger. It is just more expensive. The executive with the giant salary and the giant burn rate is not rich in the way that matters. He is a beautifully paid hostage. And the mountain punishes hostages. When markets wobble, when layoffs arrive, when one income disappears, when a child needs more than expected, when health turns strange, when the wrong year appears, the person wearing the velvet backpack discovers what I have always believed. Material status is a weak substitute for slack. Slack is what lets you breathe. Slack is what lets you refuse. Slack is what lets you survive a weather shift without climbing into debt or panic. The people in The Millionaire Next Door understood this better than most modern high earners. They kept simplicity when income rose. They did not turn every raise into proof. They protected the climb. They understood that the most impressive luxury is not the visible purchase. It is the invisible margin. Your source nods to that tradition, and it should. It is one of the oldest correct ideas in personal finance. Fay Filicite Fay turn 68 file 0 Fay the third trap is the one people hate because it sounds tedious, and tedious things usually turn out to be expensive tax inefficiency. I call it the oxygen leak. At altitude, a small oxygen leak does not feel dramatic at first. That is why it kills. Taxes work the same way. They do not usually blow up your portfolio in one theatrical moment. They just keep taking your breath in the background while you act as though the real problem is somewhere else. Your source puts this plainly. For many successful households, taxes are likely the largest single expense, not the car, not the rent, not the travel taxes. That means small inefficiencies are not small, they are structural leaks, wrong asset in the wrong account. Capital gains triggered carelessly. Tax loss harvesting ignored. Retirement accounts underused, HSAs neglected, dividend. Heavy positions left in taxable accounts where every payout becomes a recurring haircut. Fay Filicite Fay turn 68 file 0 Fay. This is where serious people separate themselves from lazy rich people. Lazy rich people pay unnecessary taxes because paperwork feels boring. Serious people understand that taxes are not just a government issue. They are a capital allocation issue. A dollar saved from unnecessary tax drag is not merely a dollar saved. It is a dollar that stays in your compounding engine instead of being siphoned out by preventable stupidity. That matters, especially when the balances get larger. A lot of people are emotionally willing to lose money in markets before they are intellectually willing to study the tax code. That is backwards. It is like obsessing over mountain boots while ignoring the hole in the oxygen line. The fourth trap is similar in spirit and uglier in its laziness. Giving up refinancing opportunities. I call it the frozen rope. The source material, S-mortgage example, is useful because it forces the point into arithmetic. A $400,000 mortgage at 7% versus 6% changes monthly cash flow by roughly $263. Yes, refinancing costs money. Yes, maybe around 2 to 3% of the loan. Yes, maybe it takes roughly 38 months in that example to break even if the fee is around $10,000. But that is not a point. The point is not that refinancing is always correct. The point is that a shocking number of people do not even do the math. Fay Filicite Fay turn 68 file 0 Fay, they stay tied to an old expensive structure because movement feels annoying. That is the frozen rope. You are still attached to a bad line, but because cutting and retying requires effort, you keep paying the old cost and calling it normal. This trap applies far beyond mortgages, car loans, business debt, credit lines, insurance contracts, every place where a better structure might exist. But you refuse to examine it because the current arrangement is familiar enough not to scream at you. That is what middle-aged financial drag often looks like. Not some giant act of incompetence, just expensive inertia. The fifth trap is where the mountain becomes morally interesting, overworking. I call it summit blindness. The source material says this trap is not even really about money, and that is exactly right. But it becomes a financial trap because the value of your time changes as net worth rises. If you have $5 million producing a conservative 5%, your capital is already making roughly $250,000 a year, about $684 a day, whether your body is exhausted or not. The question becomes brutal. At what point does the extra hour stop being ambition and start being theft from your own life? Fay-Felicite, Fay turn 68, file 0 Fay. A lot of successful people never ask that question. They keep climbing because climbing became identity. They keep working because work became proof. They keep squeezing because stillness feels like death to them. That is summit blindness. You come so far up the mountain that you forget why you were climbing in the first place. You say you wanted freedom. Now you have enough money to buy more of it. And yet you continue to sell the same hours back to the same machine because the machine taught you to worship the feeling of strain. This is a dangerous inversion. Money should gradually buy back your calendar. If it only buys bigger obligations and a prettier exhaustion, you did not climb well. You just climbed high. The sixth trap is one I have always despised because it disguises itself as excellence. Early success. I call it altitude sickness. The source material S example is perfect because it reveals the emotional pattern so clearly. One man concentrates into 10 stocks, gets strong years in 2023 and 2024, mistakes a favorable environment for permanent genius, cuts from 10 down to 5, starts trading options around earnings, starts using margin, and then ends up deeply underperforming when conditions change. That is not bad luck. That is altitude sickness. Fay-Felicite, Fay turn 68, file 0 Fay, altitude. The mind becomes less trustworthy. Early success can do that to investors. You stop seeing risk because recent reward numbed your caution. You call recklessness confidence, you call concentration conviction, you call leverage sophistication, you call options precision, you call day trading skill, and then the mountain shows you how thin the air really was. Your source cites the familiar statistic that up to 90% of day traders lose money. I am not surprised. Day trading is not mainly an investing activity. It is an emotional volatility business masquerading as strategy. Most people are not wired for it. And even those who survive a while often survive because the environment carried them, not because they had any durable edge. Fay-Felicite, Fay turn 68, file 0 Fay. This is why I distrust people more after 2 easy years than after 2 hard ones. Easy years make the ego swell faster than the method improves. That is when mistakes become elegant. The seventh trap is not dramatic enough for most people to fear it. Financial overcomplexity, I call it the tangled rope. Multiple brokerage accounts, multiple banks, angel deals, private equity, real estate partnerships, old retirement accounts, new tax accounts, side bets, scattered positions, hidden fees, unknown exposures, unread documents, pretended understanding. That last part matters. The source material notes that a meaningful share of high-income earners admit they only pretend to understand major investments, and that asset structure, risk, and fees matter more as complexity rises. That is one of the most honest things in the whole piece. Complexity lets vanity hide ignorance. Fay-Felicite, Fay turn 68, file 0 Fay, the person with 6-figure decisions and half. Formed understanding is not sophisticated. He is standing on a mountain entangled rope, pretending the knots are strategy. Complexity is expensive because it multiplies blind spots. You miss fees, you miss concentration, you miss tax friction, you miss hidden correlations, you miss timing mismatches, you miss the fact that your own life has become too hard to read. I have no objection to complexity. When complexity is necessary and mastered, I have deep objection to decorative complexity. Decorative complexity is what insecure wealthy people often build when they want to feel advanced. Simple systems are easier to protect. Readable systems are easier to improve. And when complexity truly becomes necessary, that is precisely when advice from a competent fiduciary or planner can become rational. Not because outsourcing thought is noble, but because pretending to understand what you do not understand is one of the costliest habits in wealth. The eighth trap is one I respect because it destroys people who look rich. Insufficient liquidity. I call it the dry oxygen problem. Too many assets, too little cash, too much net worth tied up in housing, retirement accounts, partnerships, private deals, paper gains, things that look wonderful on a statement and useless on a Tuesday when a real opportunity or a real emergency appears. Your source says it plainly. Many millionaires have less liquid cash than outsiders imagine, and for families with roughly $1 to $2 million, around 2/3 of wealth can be trapped in housing and retirement accounts. That is what paper altitude looks like with dry oxygen. You look high up, but if the environment changes, you do not have enough immediately usable air. Fe filicite fe turn 68 file 0 fe liquidity is power. Not because cash always earns the most, because cash lets you act, because cash prevents forced selling, because cash gives you calendar, because cash turns weather into opportunity instead of panic. This is why the source material's basic rule of keeping at least 3 to 6 months of expenses in liquid reserves is correct, but often too thin for complex lives. If net worth is rising, income is high, expenses are low, and opportunities matter. Then more liquidity can be rational precisely because the cost of illiquidity gets larger as your life gets more complicated. Fe filicite fe turn 68 file 0 fe the ninth trap is one of the cruelest because it looks small in the moment and enormous in the rear. View mirror, delaying retirement saving. I call it the runway penalty. The source material gives the familiar chart logic, save modestly from 25, and the ending line is vastly different from starting at 35. That is not motivational fluff, it is arithmetic. And the difference is not just the extra 10 years of contributions, it is the extra 10 years of compounding on the earliest money. Time is not linear in these systems. It stacks, it amplifies, it humiliates procrastinators. Fe filicite fe turn 68 file 0. Fe people always want a heroic answer. How do I catch up? How do I make up lost time? How do I find the high return move? Usually the right answer is uglier. Start now, stay away from debt. Live below your means. And when your pay rises, save at least half of the raise. That last rule from the source is worth far more than its simplicity makes it look. Half of each raise saved directly. That is how you escape lifestyle creep without having to become a monk. It is one of the few financial rules that stays powerful across almost all income levels. Fe filicite fe turn 68 file 0 fe the modern mistake is not always that people never save. It is that they let every income increase get intercepted by the velvet backpack before the future gets a vote. The 10th trap is the one people postpone because they do not like thinking about loss insurance. I call it the open flank as net worth rises. You collect more things that can be damaged, sued, stolen, or underprotected. House appreciates. Liability grows, family dependence grows, earnings matter more. The cost of a bad event rises. Yet many people continue carrying insurance decisions made for an older, smaller version of their life. That is crazy. The source material is right that declared values and coverage limits must be rechecked as assets grow. A growing balance sheet with stale coverage is not prudence. It is vanity. You are admiring the castle while leaving the side gate open. Fe filicite fe turn 68 file 0 fe insurance is not glamorous. Good, neither is structural intelligence. The mountain does not care whether you found the checkup romantic. It cares whether you left the flank exposed. Now let me tell you what connects all 10 traps. Every one of them is a version of the same mistake, ascent without redesign. That is the deep pattern. You make more, you own more. You invest more, you earn more, you gain confidence, you gain assets, but you do not redesign the system strong enough to carry the new altitude. So the old weak habits come up the mountain with you. Old concentration impulses, old spending impulses, old laziness around paperwork and structure, old addiction to work as proof, old ego, old complexity theater, old discomfort with liquidity, old procrastination, old denial of downside. The account got bigger. The operating system did not. That is why I call it altitude risk. You did not just climb. You carried old code into thinner air, and thin air punishes old code faster. This is why so many smart people become weaker as they get wealthier. Not morally weaker, structurally weaker. They do not notice because the numbers keep going up for a while. But that is exactly when danger is greatest. Bull markets cover stupidity. Rising incomes cover fragility. Appreciating assets cover structural laziness. Easy years cover weak character. The cover always blows off later. So what should you do? First, cut any position that has become identity. If one holding can emotionally or mathematically decide the fate of your future, you are no longer managing wealth. You are managing obsession. Second, treat every raise as a test, not a reward. Do not ask what new expense can carry the new income. Ask what new freedom the new income can buy if not consumed. Third, put tax structure on the same level as investment structure, asset location, holding periods, harvesting, retirement wrappers, HSA use. If you hate this work, fine, hate it. Then do it anyway or pay someone competent to do it. Oxygen leaks do not close because you find them boring. Fourth, audit your debt architecture. Mortgages, cars, loans, credit. Do the ugly math. Not every refinance is smart, but every unexamined expensive structure is a sign of drift. Fifth, ask when your time became more valuable than your extra effort. If your capital, income, and life no longer require the same grind, then continuing the grind without redesign is not virtue. It may be addiction. 6. Punish arrogance early. 2 good years do not make you immortal. 1 bull cycle does not certify genius. If your success is making you more concentrated, more leveraged, and more theatrical, then you are not getting stronger. You are getting sick. 7th, simplify what you can read and map what you cannot. Complexity should exist only where it truly earns its keep. Everything else is ego trying to look sophisticated. 8th, increase liquidity until your life stops being one forced sale away from stupidity. Cash is not a moral failure. Cash is climb insurance. 9th route raises into runway, half saved, maybe more. The future must intercept the raise before the present learns it exists. 10th, close your open flanks, home coverage. Umbrella liability where appropriate, disability. Life insurance where family depends on you. Asset values re-verified. The right flank should not be where your whole mountain falls apart. Now let me make this personal as your net worth grows. The real question is no longer, how do I make more? That is still a valid question. It is simply no longer the only one. The more important question becomes, what can now destroy me more politely than before? That is how adults should think. A young broke man worries about the obvious storm. A mature wealthy person must worry about the polished mistake, the wrong concentration, the expensive lifestyle, the ignored tax drag. The unexamined refinance, the inability to stop working, the ego from recent gains, the unread complexity, the dry oxygen, the delayed runway, the open flank, these are not dramatic in the way people expect danger to look. That is why they are so dangerous. I have seen people who looked like they had get trapped by 3 of these at once. Big income, big house, thin liquidity, aggressive concentration, little tax discipline, old insurance, great confidence. Then 1 market shift, 1 business disappointment, 1 health event, 1 rate move, 1 lawsuit, 1 bad sequence, and the mountain collects. People say things like no one could have seen it. Nonsense. The traps were visible. They just looked respectable. That is the key lesson. As your wealth rises, your mistakes stop looking sloppy. They start looking legitimate. That is why self-awareness matters more at altitude than ambition. Ambition gets you climbing, self-awareness keeps you alive. So here is the final test. As your net worth rises, are you becoming lighter, cleaner, simpler, more liquid, more diversified, better protected, more tax-aware, less ego-driven, and more selective with your time, or are you just becoming a more expensive version of the same fragile person you used to be? Because the mountain does not care what your statement says. The mountain cares what happens when the weather turns. And when it turns, it will not ask how high you climbed. It will ask whether you climbed intelligently enough to stay standing.